Hey you, how's it going? Welcome back to a new video. I'm Craig Coleman, I'm a qualified mortgage advisor, and today I'm going to be talking to you about types of mortgages. But before we do that, make sure you give us a thumbs up, click that subscription button and turn the notifications bell on. It really helps the videos, and it also lets you know when I've uploaded videos so you can stay updated with anything to do with fitness and finance. But getting into it then, types of mortgages. What is a mortgage? A mortgage is a loan against your property, okay? So it's secured against your property. Typically these are your longer sort of loans. They can go on to 25, 30, 35 and even 40 years. And if you don't make those payments, then the lender, the bank, the building society can basically repossess your property and then sell it to sort of redeem as much money as possible. And then when it comes to you purchasing a property, you're going to be looking at two types of mortgages. And depending on the type of purchase will depend on the type of mortgage that you go for. So we've got a capital repayment mortgage. With a capital repayment mortgage, you are paying a bit of capital, so you're paying some of the loan back, but you're also paying interest. So interest is how the bank is basically making money for lending you the money to purchase your home. What we see with this though is when you're making these payments at the start of the mortgage, the payments are going to be more interest than they are capital. So you're going to be paying a lot more interest on the mortgage and paying less capital. So your loan is decreasing slower than it would do at the end of the term, because at the end of the term you'll be paying back more capital and less interest. This is how the bank works out, or the building society, the lender, works out your payments at the start of the mortgage. Say you're working out a 25-year term, they basically work out what the payments will be, a certain percentage, and then as you pay more capital, you owe less on the loan, so you owe less interest and you start paying back more capital. So that's how that works with your sort of fixed payments. These, when it comes to these, typically they are more expensive each month because you are paying more capital and more interest, but you've got that guaranteed repayment vehicle. So it's preferred by the lender and it's also preferred by the client, because at the end of the term, whether that's 20, 21, 22, 25, 30, 35 and 40 years, we know that that loan is going to be paid off and you don't owe anything to the lender. For the second type of mortgage is we've got an interest only mortgage, and it's exactly what it is. All you're doing is servicing the interest. So you take out £100,000 loan, at the end of the term you still have a £100,000 loan to pay, because all you've done is just pay interest to the lender. These are definitely not preferred by the lender or the client when it comes to sort of a residential property, unless you've got some sort of repayment vehicle like an ISA or quite a bit of money sort of in the bank to say that you're able to pay it off, just because you get to the end of the loan, people haven't sort of paid into their repayment vehicle, and what can happen is if the property's gone down in value and you get to pay, you have to pay back the loan, you're then going to have a shortfall. So if you sell the property and the cash isn't there, the equity is not there to pay the lender, you then got to find that money to pay back the loan, and it can put you in severe debt and put you into severe problems. So that's why it's not preferred. Typically we see an interest only mortgage with sort of a buy to let property, because it keeps your payments lower because they're less expensive, because all you're doing is paying interest. So one, you can make more profit when you're renting out the property, but also if you ever have times when there's not a tenant in the property, you've only got to worry about paying the interest and not the capital and interest. So when it comes to purchasing a property, you want to have a think about, are you purchasing a buy to let or are you purchasing a residential? To summarise, we've got two types of mortgages. You've got your interest only. These are less expensive because all you're doing is paying back the interest, but you will need some sort of repayment vehicle to sort of pay the loan back at the end. And remember that if your property has gone down in value, then you are going to have a shortfall. Secondly, you've got your capital repayments. So you're paying a mixture of capital and interest. They will work out more expensive, but it's definitely preferred by the lender and the client because they know that the loan is going to be paid off at the end of the term. Hope this video has been helpful. Let us know what you think. Give us a thumbs up if it does. Remember to click that subscription button, and I'll see you soon.
Dear mama, something's wrong. It's cold for a summer night. I feel there's something far beyond what is in my sight.